for more on the markets this morning, we are joined by Chris Markowski, who is the host of Watchdog on Wall Street radio show and the president of Markowski Investments. So great to have you on this morning. Back to those retail sales numbers for the month of May. Yesterday, they came in at double expectations, rising about 17.7%. Following a really bad March and April. Are investors, you think, reacting too positively to the data, given the fact that we're still very much below where we were this time last year?
Oh, absolutely, we're below. But I have to admit, when I was down in Florida and the stores were opened up, my wife had almost a spike the football type of a moment when she went out to the International Mall and was able to get out shopping once again. People need to understand that people have been saving a lot of money. They haven't been going out to eat. They haven't been able to go to sporting events. Many of the things that they'd spent money on in the past just haven't been able to do it. So they have some extra cash on hand. And luxury goods in particular are going to be doing very, very well. Spending patterns are going to change a little bit. But yes, there's some pent up demand when it comes to retail.
Let's talk a little bit about just the change in trends. You say spending patterns are going to change a bit because despite these numbers that we got yesterday, many retailers like J. Crew, Pier 1 Imports, JCPenney, Aldo, and many more have filed for bankruptcy. We see them on the screen there. These companies, many were struggling though prior to the pandemic. One thing I've heard that's interesting is just the pandemic kind of expedited a lot of what we may have otherwise seen in this retail industry. Would you agree?
I'm a big believer that recessions, whether they're caused by a government shutdown, which is odd, the first time we've seen this happen, or a monetary issue, banking crisis, whatever it may be, they act like a lymphatic system. Basically, they're cleaning out all of the bad companies out there, and it just gets it done that much quicker. So one thing in common with all these companies you're seeing going bankrupt on the retail side is that they were really, really weak going into this.
What do you think, investors? Do you think that they should keep cash on the sidelines, or do you think it's time to put it to work, especially given the fact that the market's back to being expensive again?
Oh, it's expensive. But the one thing about this is every investor is unique and different, and one's position in cash is going to be different if you're closer to retirement or you need cash on hand to buy a house or whatever it may be. We've always been a big believer in dollar cost averaging if you are a long-term investor, not trying to pay attention or trying to time the markets. We're living in a very, very unique period of time where the Fed has basically come in and said, hey, you know what, we're backstopping everything. There's a lot of cash on hand. And you see yesterday, you mentioned the steroid being used in treatment, how that can drive the markets to the upside, or a vaccine story can change the market dynamics very, very quickly, which makes it impossible to time.
Mortgage demand, we saw that spike to an 11-year high. We just got some new numbers in this morning. The real estate market is changing so dramatically. For example, about 5% of New York City's population has fled amid the coronavirus, and a lot of people won't be back. What do you think is going to be the long-term impact on cities and suburbs from this pandemic, specifically this flight that we're seeing?
Well, suburbs are killing it. Interesting today, the housing starts numbers were a little bit weaker than expected. And that, in essence, was more due to the fact that you couldn't get construction workers out because of the extended unemployment. Housing markets in the suburbs are booming right now. It's not just that. It's also things like pools, second outdoor kitchens, things of that nature that people are spending money on to a much greater degree than they were in the past. Yes, I do think that the trend is going to continue, and I do think people are going to continue to leave the major markets and major cities.
Even after the pandemic, do you think it's just because more people will be able to work remotely?
I think that's without a doubt, plays a part in it, but it's also going to do pressure from various different businesses. If I'm a corporation and I can have somebody work in a no tax state, pay them less money in regards to salary, but have that worker have more money in his pocket because their expenses are lower, that's a win-win situation. It's a win for the worker. It's also a win for the corporation. It makes them more profitable.
Yeah, it's so interesting. We saw Facebook mentioning that they were going to do something like that, Stitch Fix as well. Do you think that the housing market, though, should we expect a wave of foreclosures when that 90-day mortgage grace period expires around the country?
it all depends on what the government is going to do next. The government, like I said, is throwing money at everything. For all we know, they may extend that for an even longer period of time. We all know from the financial crisis, the banks don't want to foreclose. That's the last thing in the world they want to do. They don't want to have to take care of the house. They don't want to have to cut the lawn in any of these situations. So I don't think it's going to be as bad as everyone thinks it is.
All right. Chris Markowski, host of the Watchdog on Wall Street radio show and president of Markowski Investments. So great to have you on this morning.